Assalamualaikum everyone. This is our virtual lecture on topic 2, measuring domestic output and national income. As always, please use the slides together with your lecture notes and the required textbook. We will begin our lecture with what is GDP. So in this part, you will learn more about the concept of gross domestic product, what it includes, what it excludes, and what constitutes its calculation. To understand the gross domestic product, we need to know what macroeconomy is. Now, recall topic 1. Macroeconomics is the study of the economy as a whole. And one of the goals or objectives of macroeconomics is economic growth. Economic growth is an increase in the economy's output over time. In other words, an increase in the size of the economy. One of the best and widely used measure to measure this size of the economy is the gross domestic product. Now let's look at the terms one by one in GDP. Gross. Gross refers to the total monetary market value. Monetary is important because monetary measure is used to allow the summing of goods and services and enables comparison of different goods and services in different years. Domestic. Domestic refers to anything that is produced within a country. And product, it refers to all final goods and services. Now, if you put these three terms together, we will get the definition of GDP, which is the total market value of all final goods and services produced within a country in a particular time period, usually 1 year. Now, it is important to know the characteristics of GDP. Number 1, GDP avoids double or multiple counting. What that means is it only counts the final goods and services produced for final use and not for resale, further processing, or manufacturing. In other words, GDP eliminates intermediate goods. The reason is because the value of the final goods and services will already include the value of all the intermediate goods that were used to produce them. So that is why, alternatively, GDP is also known as adding up only the value added at each stage of production. Here is an illustration, which I hope will be able to make you understand this concept better. Now, assume this product. It goes through 4 stages of production: cotton farmer, textile mill, shirt manufacturer, and finally to the retail store. Now, the final value of this product is worth 20 ringgit. Okay, so for the calculation of GDP, we only include 20. Now, alternatively, if you want to use the value added method, what we need to do is to just add up the value added at each stage of production. For instance, from nothing to having cotton here, the value is 1. So that's the first addition for the first stage. Now, the second stage is from cotton farming to the textile mill, the additional value is 4. Okay, from textile mill to shirt manufacturing, the additional value is 7. From shirt manufacturing to the retail store, the additional value is 8. So now if you were to add 8 and 7, 4 and 1, we will get 20. Okay, so I hope you understand that, okay, to conclude, the final value of output equals to the sum of the value added by each stage of production. Now, you need to remember that the GDP is the value that has been produced in the economy, okay, not what was actually sold. The second characteristics of the GDP is that it excludes non-production transactions. Why? Simply because they have nothing to do with production or the generation of new goods and services. Now, there are numerous types of non-production transactions, but the main 3 are as follows. Firstly, GDP excludes existing assets or property sold or transferred, including used items. This is because the value of those items have already been included in the GDP on the year it was produced. Secondly, GDP also excludes purely financial transactions, such as public transfer payments, for instance, welfare benefits, or pension, or zakat. It also excludes private transfer payments, for instance, student allowances that were received from parents, or alimony payments between divorced couples. And they also exclude stock market transactions, for example, sale of stocks and bonds. However, the broker's fees are included for services rendered. And thirdly, GDP also excludes second-hand sales. This is because they do not represent current output, such as used car dealers. However, if there are any value added between purchase and resale, then that is included. Now, having known the two important characteristics of GDP, we can now move on to how to calculate or how to compute GDP. In this course, you will learn how to compute GDP in two ways. One is called the expenditure approach, and the other is called the income approach. Expenditure approach is basically adding up all of the total amount spent on all the goods and services in a year, whereas income approach is adding up all of the amounts earned by all the factors of production in producing the final goods and services. Let's move on to the second part of our lecture, which is to measure GDP. Here you will learn two ways or two measures on how to calculate the GDP. The first way to calculate GDP is called the expenditure approach. This approach basically adds up the entire amount spent on goods and services by four categories of buyers in the market. These four categories of buyers are consumers, businesses, government, and foreign buyers. Let's look at these four groups one by one. For consumers, the items included in GDP is called the household or personal consumption, denoted by C. Now, what are the items included in this calculation? Well, it includes durable goods, which are items that last 3 years or more, for instance, cars or houses. They also include non-durable consumer goods, such as food items like milk or vegetables. And they also include services, such as dentist, lawyer, and even education. Now, the second group of buyer is businesses. So the items included in the GDP for businesses is called gross private domestic investment, or denoted as IG. We can call it gross investment for short. Now, what is included under gross investment? Well, what's included is all final purchases of machineries, equipment, and tools used by businesses in order to produce their goods and services. They also include all construction, including residential. It also includes all money spent on research and development or creation of new creative works, and they also include the creation of new capital assets. Now, it must be remembered that when you talk about gross here, the word gross simply means, or it includes new capital, replacement capital, as well as added capital. So sometimes we want to know there would be a difference between gross and net here. So the difference is basically depreciation. Now remember, each year as we produce more of current output, the existing output may be deteriorating in terms of quality or physical ability. So the wearing and tearing of these items or assets is basically called depreciation, right? So if you minus or if you take out depreciation from the gross investment, you will get the net investment. Okay, so in other words, typically, if your gross investment is more than depreciation, what we say is we have a positive net investment. If our gross investment is lower or smaller than the depreciation value, we will have a negative net investment. And if our gross investment is equals or same amount as the depreciation, we say that we have zero net investment. So for this particular part, please refer to the textbook for more information, because normally they might ask, questions in the MCQ or whatever. So you do not want to get confused between gross investment and net investment. And another thing that you need to know or pay attention to is that we only take into account changes in business inventory. Why? Because total stock of inventories will include past productions. Remember, for GDP, we only want the current year's production. So that is why we only consider changes in business inventory. So basically, if we have an increase, okay, I'm planning to do an arrow here. Okay, let's do it again. That looks horrible. Okay, if we have an increase, okay, that looks much better. If you have an increase in inventory, it must be added to the GDP. Whereas if we have a decrease or a fall in inventory, it must be subtracted from the GDP. Okay, so here I would like you to highlight or to remind you that these two down here, changes in business inventory and net private domestic investment, they're not exactly a part of the gross investment, but it's important for you to identify whether or not those items are included in the calculation of GDP. Okay, so we've looked at consumers and businesses. Now let's look at the third category of buyer, which is the government. So government also makes purchases. This includes all of the spending done by government at all levels of government. For instance, the federal level, state level, as well as the local government authorities. And it also includes all spending on all consumption and capital goods to provide public services. They also include spending on publicly owned capitals such as schools and hospitals. They also include all spendings on research and development to improve know-how of government servants. It also includes all direct purchases of resources such as labor. However, the G, or government purchases, excludes transfer payments because these do not reflect current production. Now, the fourth category of buyer, as I mentioned to you just now, are foreign buyers. So the category, they are called net export, or XN. This basically refers to all the spending on final goods produced in the nation. Okay, so anything that's produced in our country, it must be included in our GDP, regardless whether the purchase is made inside Malaysia or by other countries. At the same time, so this is basically called export. So whatever it is that we export, meaning it is produced in Malaysia, right? So we need to include it in the calculation of GDP. However, sometimes we import goods from other countries, so this one needs to be subtracted. That is why here it is called net export. Net export simply means total export minus total import. So the net export is the one that is included in our GDP calculation. So to summarize, okay, to calculate GDP using the expenditure approach is basically C plus IG plus G plus XN. Okay, so here is a practical example of the calculation of GDP using expenditure approach in our country. So I got this from DASM, or the Department of Statistics Malaysia. So as you can see here, remember the four categories of buyer. First of all is the personal consumption made by us, households. Okay, this refers to, this is the first group of buyers, C, private final consumption expenditure. And the second group of buyer is businesses, right? So businesses here is quite a huge group, right? So this is your IG, okay, which is called gross fixed capital formation. And then we have the third group, which is the government. Okay, this is the G. And finally, we have the net export. So here's the exports, total exports, less or minus imports. So here we have the XN. So obviously, whatever we learned just now was theory or theoretical. Every country has their own specific ways to measure their GDP. So it helps to look into the formal or official government circulars and government publications to understand what are the specific details on the calculation of GDP for that country. The second way to calculate GDP is called the income approach. The income approach basically adds up all of the incomes earned by households in exchange for the inputs that they contribute towards the production of goods and services in Malaysia. So here we have four categories of income. Now, if you want to know why are there four categories of income, recall in topic 1, there are four categories of factors of production or inputs, remember? Land, labor, capital, entrepreneurship. So those four categories of inputs or resources or factors of production, each one of those inputs, when they contribute to the production of goods and services, they will get income in return. So that is basically the categories of income that we use in this calculation. Now let's look at them one by one. Okay, so the first one refers to the labor factor of production. So for laborers, what do they get? They will get compensation, such as wages, salaries, fringe benefits, and payments, which are made on behalf of workers, such as Social Security and other health and pension plans. So that's the first factor of production, which is labor. Second, we have under land. Remember land? So for land, there will be payments made for those who supply their land or other property resources, for instance, lease payments, which is adjusted for depreciation, of course. Okay, in other words, you can call it net rent or rental. The third category of factor production or resource is entrepreneurship. Okay, so here we have labor, then we have land, and we have entrepreneurship. So entrepreneurship here consists of two. One is the proprietor's income. Proprietors include sole proprietorship, partnerships, cooperatives, and we also have corporate profits, which includes dividends, retained earnings, and corporate income taxes. Dividends are given to shareholders, whereas retained earnings are not distributed, and corporate income taxes is basically a flow or an income to the government. Now, the fourth category of resource or factor production is basically capital. Okay, so what's included in the calculation of GDP is net interest. So this refers to payment to the supplier of capital or money capital. So of course, you must take into account the difference between interest income earned and interest payment. So that is why we only take into account net interest. Okay, guys, so we have these four categories of income, which comes from the four categories of factors of production. Now, when you add these four incomes together, please know that you do not get GDP yet. Okay, when you add these four together, what you have is basically called national income. Okay, so national income is basically a total income from Malaysians, whether it is earned in Malaysia or abroad. Okay, now how to get GDP from national income? Okay, we have to make several adjustments. Specifically, we need to make three adjustments. The first adjustment is that the national income here, we have to add indirect business taxes, such as sales tax, excise tax, business property taxes, license fees, and custom duties. Why must we add these indirect business taxes? Because they are income to the government. Okay, so as long as it's an income to the four categories of resource providers, you have to add it in the calculation of GDP. Okay, in the textbook, it is called taxes on production and imports. Okay, so read on that. Okay, the next thing we need to do is to add depreciation, or also known as consumption of fixed capital. Okay, this includes, why is this included? Well, it's included because we want to reflect incomes that we get from the replacement of plants and machineries. Okay, so depreciation allowance is a cost of production, so they must be included to get the gross value product. Remember, GDP is called gross domestic product. So yes, you have to add back depreciation. And finally, we also need to include or exclude, in this case, net foreign factor income. What is net foreign factor income? It's basically foreigners' income in Malaysia. Okay, we deduct Malaysian incomes coming from abroad because, yeah, so yeah, I think I've written down here for you. Incomes of foreigners who supply resources in Malaysia. And this is included because although they are foreigners, they're not Malaysian, but they are helping in the production of our country. So yes, we include that in. At the same time, we do have Malaysians living and working abroad. So although they are Malaysians, but they are not producing for Malaysia, so we need to deduct whatever incomes that we get from them because it does not represent production in Malaysia. Okay, so now recall whatever we have just now, national income plus indirect business tax plus depreciation minus net foreign factor income. Now all of this is finally our GDP. Okay, so to summarize, GDP under the income approach is basically the national income coming from these four categories of resource earners plus depreciation plus indirect business taxes and minus net foreign factor income, then you get GDP. So here's a practical example of how to calculate GDP using the income approach. Again, I got this from the Department of Statistics, Malaysia. Okay, so in Malaysia, this is how our government calculates GDP using the income approach. So the categories are compensation of employees. Then they also include the gross operating surplus. This is quite a huge category, which includes operating surplus and mixed income from various sources. And of course, they also include taxes less subsidies on production and imports. So yeah, as you can see, it may be a bit different from the theories that we've learned, but the essence is the same, guys. Okay, so this refers to the categories of income earners in our economy. Okay, so having learned the two different methods of calculating GDP, which are expenditure approach and income approach. Here, why do we compare them? Okay, so see how is GDP measured. First of all, we begin with the definition of GDP. GDP is basically the total production of goods and services in the countries. Remember, when we talk about total here, refers to monetary measures, yeah? Okay, so we only focus on these two, expenditure approach and income approach. Of course, in practice, in Malaysia, we have the third measure of GDP, which is called the output or production approach, but this will be excluded in our syllabus. Now, once we have the GDP measured by these two approaches, we have the GDP here. Okay, so in practice, the government may publish the report individually, or sometimes they might take an average of these two. So yeah, so basically this is GDP, and I hope you understand the concepts better with me sharing some practical examples. Okay, so we've come to the end of our virtual lecture. As always, please do read these notes together with your lecture notes and textbook. Okay, especially to those who have no background in economics, you have to read the textbook. Okay, there's no shortcut about it. If you have any questions, you can email me, or can you write comments in Google Classroom, or you can just ask me in class when I see you. Okay, so that's it. Have a nice day. Assalamualaikum.